Stock market chaos resumes. Oh, baby, do we have fun times in the stock market going on right now. Russell's down about 7% just in the past 5 trading days. The VIX is ballooning. Look at this VIX. In the past 5 days, this baby's up 37%, up 25% on Friday. I mean, just an incredible move in regards to the VIX there, right? We have earnings left and right, Palantir earnings coming, Uber, Celsius, Fubo, Supermicro, Rivian, Airbnb, Winning Resort, Shopify, Robinhood, Elf on a Shelf, Disney, one after another this week. We'll just spend a moment kind of talking about some of these earnings coming this week, and then I want to react to 3 videos in this one. Looking forward to actually reacting to a few videos. It's been a while. It seems like Wall Street's fear gauge hits highest level since March 2023. Looking forward to getting into that one. This one, entire value of Amazon can be justified by just AWS. I think that's a really interesting, compelling point. I want to react to that. And last one up here, Goldman Sachs. Eric Sheridan on why Amazon is still a good name to own, because obviously Amazon was down huge on Friday, $167. I think it got down to 165 or so. So appreciate y'all joining me as always. Thank you so much for being here. Thank you for being subscribed to the channel, folks. I will be live streaming Palantir's earnings on Monday after the bell if you want to join me for that. I'll put the pinned comment down there, my Twitch channel. Make sure you follow that and set a reminder on your phone or whatever. That'll be live streaming that earnings. Hey, I need help with something real quick, okay? Listen, somebody posted this last week. So I can't remember if this is a main channel or the reaction. Oh, it was a main channel. And I posted, well, I didn't post. I basically said in the video, I think I was mentioning we went out to eat somewhere and, just tip, tip 20%, blah, 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 right? And just happened to mention that. And somebody said, Jeremy, normal tip is 20% now. Don't be cheap. And I said, oh, wow, 20% is the normal now. Because basically my whole life, it's always been like 15% was the normal amount you tipped when you went to a restaurant or something like that. And then you went to 18% or even 20% if you got really great service, right? And so I thought like 20% was if you were like, really impressed with the service. They did a really good job. They took care of you. They were really nice, all those sorts of things, right? But now I guess some people are saying 20% is the normal. So I guess now if you get good service, I guess you're supposed to tip 25% or 30%. So let me know in the comment section if this is the reality. I don't know. Like maybe it is. Like maybe you're supposed to, I don't know, maybe tip the whole bill now. I don't know. Let me know in the comment section what you guys think about this because I'm really curious because I learn something new every day. I guess I'm old-fashioned thinking like 15% was the normal and 20% was for good service. I guess things have changed, right? So let me know about that. Alrighty, guys. So here we go. Right off the bat, I want to start out with Amazon, right? Because Amazon is obviously what we're going to be reacting to here in just a moment. And Amazon's a stock. If we pull up my big tech watch list that it got hit, it didn't even get hit the hardest, actually. Amazingly enough, Intel fell 26%. By the way, some people ask me about Intel. Am I interested in Intel stock at all? The answer is no. I mean, the company just is performing too poorly. Like, why would I buy? Just because the stock's gone down a lot, just because the stock is cheap does not mean I'd rather buy Intel versus, like, if you had to tell me, go buy something, I'd much rather buy NVIDIA or AMD versus Intel. No disrespect to Intel, it's just, I don't have to deal with, they're supposed to let go 15% of their employee workforce from what I saw. Like, they're just trying to transform the business, but they're going through really tough times. The company's been an underperformer for decades now. It's not like it's a new underperformer. The company's been an underperformer since basically the late 90s. Late 90s. I mean, I just can't, mess with the stock like that. And so at the end of the day, Intel, they lost their way a long time ago, and they continue to lose their way, and it's just not something I want anything to do with. Amazon's very different. Let me be very clear about that. Amazon is a buy. It definitely is a buy. So, but the market's getting very volatile. We don't know if this is going to continue, right? And, like I showed the Russell at the beginning of this video, here's the thing. It's like 1 minute everybody wants to buy the Russell. They're like, oh, finally the small caps are going to roll. And then the next thing you know, they're all moving out. It's 7% up, 7% down. I mean, it's incredible, the volatility here. It's like one moment everybody wants to go risk on. Next moment everybody wants to go risk off. And that's in a matter of, 3-week span? That's about a 3-week span. Risk on, or we risk on more. Straight downfall. I mean, it's ridiculous. And that's a market for you. And right now, everybody's opinions all over the place. And the reason it's all over the place is you got earnings season going on, so you got a lot of changes in kind of how people are feeling, right? But let me be very clear about this, because all of a sudden I heard a lot of people worried about the economy in the past few days. Where you been? Like nothing changed in the economy in the last 5 days. The economy doesn't change like that way. The economy's been changing for several years now, right? And if you look at the unemployment cycle, it's been trending worse for a while now. This is not new. So seeing us go from 4.1% to 4.3% should not come as a surprise. We're on a trend of unemployment going higher. If we were to all of a sudden go lower and all of a sudden we went down to 3.9, that would be surprising. But to see this trend, like, we should honestly see unemployment very soon 4.5%. Then we should see 4.7%. Then we should see 5%. That should come as no surprise to anybody out there, right? And so, the fact that all of a sudden people's opinion changed on the economy, I'm just like, where's everybody been? Where's everybody been on this stuff, man? This is like, you see the trend. It doesn't like change overnight suddenly. Like inflation. Inflation was another perfect example. I was talking about inflation at the end of 2020, right? And then all of a sudden people finally started talking about inflation going into 2022. At the end of 2021, it was like, where you been at? Like, if anybody that knows anybody that was running a small business during that time, they were already facing huge inflation, right? And the numbers were kind of being artificially kept down because you couldn't really go up on rents during that particular time. There was all types of crap that was messing with the numbers. But the reality around inflation was way worse, way before anybody really noticed. And then all of a sudden, everybody paid attention to it. And so right now, it's like all of a sudden, everybody wants to pay attention to the unemployment rate. And it's like, where you been at, man? Where you been at? No, this week's a huge week. Palantir earnings. I did a full in-depth video about Palantir, kind of my expectations. Do I think they're going to beat earnings, miss earnings, all those sorts of things on the main channel. I probably put that video out, I don't know, 3 or 4 hours ago. So you can check out my main channel, Financial Education, if you want in-depth in regards to Palantir. Hims and Hers are reporting, Lucid's reporting. Lucid's one of those companies that they have to continue to get massive amounts of funding or they're going to go bankrupt essentially, right? Hims is an interesting stock. It's been a very impressive performer and the business has been doing pretty well, but they are in a little bit of a situation recently. So I don't want to go into all the details around that, but they do have some bad dynamics kind of going around that is in relation to the company. Uber stocks reporting, that's going to be an important one for the economy. People are going to get to see those numbers. Celsius stock has fallen 55% in 11 weeks. That one, I'm very excited to see what happens there. I mean, if they still are growing that business and that stock drops in the 30s, I'll probably pick up shares. I'm like, I think Celsius looks like the type of company that can grow double digits a year. But everybody got so used to these insane growth rates at Celsius that they're going to flip out if all of a sudden the company's growing 10%. And so that would be an opportunity that I might look out there. And if it's in the 30s after earnings, and let's say there's a situation where they're still growing nicely, when I say nicely, like 10%, 15%, but it's not like the 20% plus that investors want, other people can move out of that stock. I might actually move into the stock. So, with those drink companies, you can't always expect them to grow at those sorts of rates, especially once they become a little more mature companies. The growth rates slow down. That's what happens. Fubo's reporting, looking very forward to hearing what happens with Fubo. We just need to see those losses continue to come down. Supermicro's reporting, I'm really excited for that one. That one looks actually undervalued, believe it or not. Rivian, that's one that's just, I like Rivian's products. I like what's going on with the revenue story in regards to Rivian. But the issue is this company is losing a fortune on their bottom line. They've been, and I don't know if and when that's ever going to turn around, to be honest. And when I say turn around, I mean like going from losses to profits. Like, I don't know. Tesla back in the day, I felt confident that they were going to flip over that profitability and I could see how they were going to do it. Rivian, I can't see it. And so I do have exposure to Rivian through Amazon stock, but honestly, I can't see how Rivian's going to make that flip into profitability anytime soon. That's tough. Airbnb, that's a good one to pay attention to in regards to travel, how they're feeling about bookings upcoming here. Winning Resorts is if you want to know how the higher income consumer is doing, I think Wynn Resorts is an important company to pay attention to there. Shopify is very important on Wednesday. Shopify stock looks like a buy before these earnings. If it goes down after the earnings, it's even a bigger buy. That's what I'll say about Shopify. Disney, just another mess. That's one of those you look at and it's like, man, Disney's cheap. Disney stock hasn't done anything in like the longest time, right? But when I look at a Disney, it's just a mess I don't want to get involved with. It's, sometimes it's just there's too many other companies out there. Look at Disney. The past 5 years, stock's down about 37%. But there's certain messes that I can see being cleaned up, right? Like an Estee Lauder. Like, that's a mess, but like I can see how they're going to clean that up over the next couple of years, and things are going to be fine and prosper. You look at a company like Intel. You look at a company like Disney. Those are big messes. And I don't know when and if they fix those messes. And that's why I pick and choose my spots. There's some messes I'm like, oh, we got opportunity there. There's other ones I'm like, that's just too messy for me to even mess with. Too messy for me to even mess with. And that's how I look at Disney. Great company, obviously, historically speaking. Obviously, the parks are always insanely busy. Those parks have gotten very expensive. If you're ever taking your kids there, you know that, right? So, but the end of the day, it's just a mess. I don't care if it's $89. Honestly, if the stock was $79, it's still a mess I don't want to mess with. It's a mess I don't want to mess with. Sports costs, ESPN's a huge component of that business, and sports rights continue to get more and more expensive significantly, right? Not a mess I want to mess with. Robinhood's reporting after the close on Wednesday. I'm interested to hear what they have to say about the state of the retail investor out there. Elf on a Shelf reports Thursday. They're going into their earnings like they always do, where people are doubting their numbers, and we'll see if they can keep this trend of everybody doubts earnings going in. They come out, smash it, and next thing you know, the stock goes flying again. So we'll see. I'm looking forward to that one. Trade Desk is one I'm keeping an eye on here. It's an interesting business model. The business model is pretty impressive, actually. I'll say with Trade Desk, going to keep an eye there to see what happens. Canopy might take a peek there at what's going on with those. Nikola, that's one of those companies. It's like, how is that company still public? Seriously, like some of those companies sometimes just like, how are they even, whoa, we got big. Like, how are they even still public? That's ridiculous. All right, guys, let's react to a few of these videos here.
Market sell-off special. The major index is plunging today after the weaker than expected jobs report. One place we saw a spike, well, that was in the volatility index, touching its highest level since March of last year. So what is Wall Street's so-called fear index telling us about where the market...
It's such baloney. It's such freaking baloney. Wall Street will use any damn thing to sell stocks when they want to sell stocks. They use any damn thing. Here's the bottom line. Here's another way they could have looked at that. Okay. Unemployment rate comes in worse. Jobs are worse, right? Wall Street could have easily flipped that, and they could have took the market higher and said, this is great. Powell's going to have to cut aggressively now. He's going to have to cut way faster than people expected. That's going to bring down rates. It's going to alleviate the pressure on these small cap companies. That's going to alleviate the pressure on even the larger companies that have big debt loads. That's going to take people out of savings account, out of treasuries, funnel that money in 2025 into long positions in the stock market because they're not going to be able to get any return on a savings account, a treasury. They could have easily flipped that right the other way, and that would have been the headline. Stock market booms on optimism of Fed cutting more aggressively than anybody thinks. They could have flipped it that way, and they'll flip it that way in the future. Just wait. It's just whatever way they want to flip the story for the moment is the way they'll flip it.
Headed next, Chris Murphy is co-head of derivative strategy at Susquehanna, and
that's why I don't play these Wall Street games. I stick to my game, buying great companies, holding them, long-term investments, companies that have brilliant next 3, 5, 7, 10-year futures, and call it a day. Because these Wall Streeters, man, you can't play the games with them. Because the game that they're playing is completely rigged, and they're going to rig it for whatever way they want to. So you don't play their game. You play your own game, which is buying great companies for the long term. If Wall Street wants to sell those stocks off and they're great companies, you get to pick up shares on the cheap. And then they'll buy those same companies right up. And they'll do it all in a matter of a year or two. Like 1 year, they're selling off a stock super heavy. The next year, every single Wall Street is piling into it. And the stock goes up 300, 400, 500%. It happens quick.
Discuss, Chris, the floor.
Ask anybody that owns NVIDIA stock. Ask anybody that owns Meta stock. Ask anybody that owns any big tech stocks and you were buying those stocks in 2022. Look at how fast they all ran back to those stocks after they sold out. It's incredible.
Floors do tell.
Sure. I mean, like you said, highest close in over a year. One thing that we also look at is actually two things that we look at. Term, structure, inversion. All that really means is the very near term fear and panic is elevated compared to the medium and longer term. And that's often a sign to us that much of the stress is being priced into the here and now. And believe it or not, when we see something like that happen, typically, 80, 90% of the time, a month later, the S&P's higher because it's kind of telling you a lot of panic has hit all at once.
Wow.
So
let's just let me make sure so when it's inverted like it is right now and it jumps very quickly in one day, you say you're looking at it now, it's actually a bullish sign.
Well, 9 times out of 10. So now you have to ask yourself, are we in COVID or the great financial crisis or one of those other, 1 out of 10 type scenarios? Or are we in a situation where positioning got really offsides? There's definitely some near-term pain in a lot of the most crowded positions. But is this a longer-term, systemic thing? I mean, we were all kind of waiting for rate hikes to start to slow the job market. It took a little bit longer than expected, which allowed these positions to build up much more offside. So, we might see some more near-term pain in the unwinding of those positions, and we saw some signs that might be the case. But it doesn't seem like a longer-term unknown from my vantage point.
You say buy the dip has been working all year, and investors
You need to remember the time period we're in right now. What month are we in? August, right? August and September. For 4 decades, from 1980 all the way to 2019, right? 4 decades. The only 2 months that were red over that 40-year span, August, September. This is a time period they like to sell stocks off. It's just the way it is, and they'll use whatever reason they want to use to sell these stocks off.
Positioning as if this week will be no different. Where you mentioned there were kind of 2 things you're watching, one of them being that term structure. What else is on your radar?
Well, it is interesting to note that the most consistent trade, even the last 2 days, has been investors selling downside puts, basically saying, I'll buy on further weakness. Most of the last year or so, it has been just I'll sell these puts because this has been the most profitable trade. So when we start to see some volatility, then we say, okay, well, if we continue to see all this put selling, that's a sign that investors are not as scared in their single stock names that they really like. I mean, you mentioned Amazon. Obviously, it was down a bunch on earnings. The most notable trade that we saw today was a big put seller basically saying, okay, Amazon's a little bit less expensive now. I'm willing to buy it on further weakness. That's
interesting. Chris, as always, thanks for giving us a little lens kind of further into the dynamics of this market. We appreciate your time tonight.
Alrighty, next one up here. Entire value of Amazon can be justified by just AWS. Now, keep in mind, folks, Amazon has they have a lot of big businesses, but they have 2 other massive businesses outside of AWS. The e-commerce business that I'm sure every single one of you guys has, uses Amazon, right? To buy stuff online. Probably every person watching this, a lot of you guys probably have Amazon Prime, right? Which, by the way, if you have Amazon Prime and you're going to follow me on Twitch, subscribe there. You get a free subscription each month if you have Amazon Prime. You can hook it up. That way you don't see a bunch of Twitch ads for that Palantir live stream tomorrow, right? But Amazon, like everybody uses Amazon. The other big business they have is their advertising business. Now they have a bunch of other businesses they own. They own Twitch, they own Whole Foods, they own Zappos, they own a bunch of different businesses. But the 2 massive ones are the advertising business and Amazon, the e-commerce platform, right? So, and then even when you break down those businesses, they have a bunch of large businesses inside those businesses. So for instance, the e-commerce business, you can look at that, okay, it's just a massive e-commerce business. No, it's also a fulfillment business. It's also a logistics business, right? So it's like a logistics company, a shipping company, right? A transportation company. Additionally, you could look at that as it's a payment company. I mean, you could look at it as the entertainment side, right? With Amazon Prime, you could look at it as a membership model similar to Costco. My gosh, when you start really going down the rabbit hole, there's like so many large companies inside that one segment of the company.
Now to sort of talk about some of these moves, whether NVIDIA, Apple, Amazon. I'll start where you want. Actually, you know what? Let's start on Amazon if we can, because I think you have a buy rating on that. That's taking it hard today, down about 11%. AWS was very strong. Typically, we'd sit here if they had an accelerating quarter the way they did, Gil, and we'd be talking about a stock price up. So what happened?
Well, the consumer side was weak, but AWS is still the only thing that's important here. AWS is by far the market leader in the most important technology market. Its growth accelerated from 17 to 19%. And importantly, they are catching up to Azure Microsoft's Azure in terms of AI capabilities and the ability to sell those to their customers. So AWS is doing phenomenally well at very high margins. The entire value of Amazon can be justified by just AWS. The consumer business is still a good business, but if there's a consumer slowdown, which it's abundantly clear there is, they won't be able to escape it. They'll do better than most consumer companies, but a consumer slowdown will still be a drag on the retail business. At this point, and we'll talk about NVIDIA in a second,
okay.
NVIDIA's market cap is bigger than Amazon, in spite of the fact that AWS is a bigger business that will grow faster over the next few years and is not cyclical, is recurring. So just AWS is enough to justify the current valuation, and the consumer business is still valuable, even if it will grow a little slower.
All right, clearly.
Yeah, if you're looking for, when you build a portfolio out, right, you need your main course. You need that entree. And then everything else around that main entree is like side dishes, essentially, right? And so the side dishes are important, and they can make the meal experience great, but you need that main entree. Amazon is the main entree. If somebody's looking for the type of stock that you build a portfolio around, you put Amazon at the core of it, right? Now, for me, I like to have a couple entrees. I like to have my chicken and my steak, and let's maybe have some shrimp and salmon in here as well, okay? So for me, I have I would say three really core positions, like in the public count. Meta's the big dog, right, that I build everything around. But then I also have Tesla and Amazon that are big positions as well, right? But the main one for me is Meta. So Meta and Amazon, both those companies are ones you can build your entire portfolio around. Like they're the center, they're the big dog, and you build everything out around that. That's how to properly build a portfolio. You got to have the foundation stock. If you don't have a foundation stock or two in your portfolio, you can't build the rest of it. It's like building a house with no foundation. It's all going to end up collapsing on itself over time. You got to have the foundation there, okay? So always remember that when you're going to build your portfolio out there. If you want to have a portfolio that's strong and lasting, that will make it through the bear markets and will thrive in the bull markets.
Continue to be quite positive on the name. On Amazon, again, this satellite manufacturing for Project Kuiper, I hope I'm pronouncing it correctly. I mean, that may have had an impact on costs. Is that going to be an ongoing expense?
I think it's one of the items they listed. Think about it as part of the Prime bundle. They want to wrap a lot of different capabilities for their consumer that are not just products, in order to keep people compelled within Prime. And internet access is a good one. Strategically, it's an important thing for them. I think it's Kuiper, like the Kuiper belt, and they'll continue to invest in it, but it's a small drag. The bigger items were that international profitability was down as they expand there. Domestic profitability was actually fine. There are some puts and takes around stock-based comp, et cetera. With Amazon, what we've learned over the years is they don't really care what we have to say about short-term margins in retail. When they invest over time. They can deliver 6+% margins, and that's what they will do. But in any given quarter, especially if a weakened consumer, we may not quite get that.
Yeah, and the time we have left, real quickly, I mean, all the hyperscalers continue to commit enormous amounts of CapEx, nobody backing off when we heard from them this week on conference calls. That leads me to NVIDIA. We don't have a lot of time here, Gil, but give me your take.
Short term, NVIDIA is going to have record results this quarter, probably next one. But we've had plenty of signs about why that will not last into next year and the year after that. When companies say they're over-investing, that means they're going to invest less next year. When Apple says that Apple, by the way, most generative AI is going to be done on an Apple device next year, none of it will involve NVIDIA GPUs. Amazon is now selling services based on its chips. Google is selling services based on its chips, including to Apple. Microsoft just guided to a decline in margins because of how much they're overinvesting. They would have to lay off 10,000 people a year for every year they overinvest. They can't keep this up. At some point, they're going to say we have enough, and they'll invest a lot less. The way this is going to play out is when Microsoft says we have great demand signals, what they're saying is OpenAI is telling us they need 10 times more compute for GPT-5 and 10 times more compute for GPT-6. If GPT-5 comes out and it's just incrementally better, Microsoft will say, okay, that's enough. We're going to buy less chips next year.
All right.
Whew, we have a difference of opinion on NVIDIA. All right, next one up here.
Tax tech analyst Eric
We
Sheridan.
definitely see eye to eye in regards to Amazon. There's no doubt about it. We have different opinion in regards to NVIDIA, but definitely see eye to eye in regards to Amazon.
He has kept his buy rating on Amazon, but lowered his price target to $230 a share from $250. I mean, we finished today, Eric, just below 168. Why do you feel confident that this is still a name to own right now?
Well, number one, thanks for having me on a Friday late in the afternoon. It's great to talk to both of you. Second, AWS is reaccelerating this theme around cloud computing as an output of the AI investments and hyperscalers seeing both putting cloud optimization in the rearview mirror, workload migration picking up at the enterprise level, as well as AI workloads starting to pick up and generate growth. We believe is still an underappreciated.
All right, so, yep, I mean, it's impressive. Amazon Web Services, $21.4 billion, $22.1, $23.1, $24.2, $25, $26.3. Woo! I like those percentage gains, especially recently, and then absolute numbers, right? $1.3 billion up there versus if you go back around this time frame, you're up about, $700 million. So 1.3 bill versus 700 mil. Oh, baby.
We don't think this is the end of the reacceleration growth story at AWS. And not only are you getting 19% growth, but you're also getting a mid-30s GAAP operating income margin at the same time. And we don't think AWS is valued as if it's a rule of 50 plus company inside Amazon as the first point. Second, while the consumer is becoming more volatile, and while there was a lot of noise around operating income this quarter, we would say the long-term thesis around a rising operating margin and Andy Jassy's commitment to delivering a mixture of a return to operating margins to pre-pandemic levels, as well as the advertising business contributing more margin than just that narrative is still well intact. So we still see a pathway to GAAP earnings and operating income margins that look, believe it or not, relatively cheap on earnings as you look out over the next 2 to 3 years. We have a $6.50 GAAP earnings number for 2025, almost $8 in 2026 against less than $170 price today.
Yeah. I mean, it's interesting when you lay out the thesis for Amazon, and you can argue that it's...
Let's go to 1000xstocks.com. Let's run a little valuation on Amazon. Let's play around with some numbers here. Alrighty, so this is a new valuation tool on 1000xstocks.com. You can do a bunch of different things through the service, obviously, but one of them is we can play around with kind of growth rates and what we expect for Amazon. So I would say very pessimistic case would be growing revenue an average of 10% a year over the coming years. That's insanely pessimistic considering the consumer is not going to be in a horrible spot for the next 4 years, right? It's not going to be in a horrible spot 2025 to 2028. They are right now because of 3 years of inflation, right? And that's something that obviously is very going to affect numbers very negatively in the short term. But the bottom line is that's not lasting, right? Consumer has ups and they have downs, and they're in a big down right now. They will come up over future years. And then additionally, AWS is obviously way outstripping that growth. So 10% is a pretty darn low number. Now, in terms of net income, that's much less of a focus for Amazon over the past 10, 20 years than certainly revenue. So their net income should go up dramatically faster than ultimately their revenues. So I would say at least 20% a year. They would put net income margins at only 11% come 2028, which that's a very low net income margin, especially when you have Amazon Web Services, which is honestly one of the greatest business models ever. So I think a 25 minimum PE for Amazon over the coming years is kind of what to expect minimum, but 35 I think is a little more realistic. That's my personal opinion in regards to that. So, I think I put a 36 here. Let's change that to 35. There we go. So, right now, stock's 167, right? So, it's kind of where you would expect it to be right now, roughly. Based on 2025, the stock should be somewhere between about $140 and $196, just assuming these numbers are correct here, right? Which, once again, look at the net income growth this company put up. 20% is not high for the coming years on average. And then look at the revenue growth over time for this company with a horrible consumer backdrop, right? Where a lot of big consumer brands are having their revenues go negative. 10% is a really low number, really low. So 140, 196 next year. 2026, 168 to 235. 2027, $202 to $283. And then over here for this one, we have $242 to about $339, right? And are you taking a big risk in regards to a stock like Amazon? No. That's the best part of Amazon, right? It's not like oh, I got to worry about Amazon going bankrupt, or I got to worry about losing 50% of my capital in the stock or 70% of my capital over the next 5 years. No, it's like, if you look at it over the next 5 years, I would say 95% plus probability you make money. The only question is, how much money do you make over the next 5 years? Do you double your money? Do you triple your money? Do you make 50% on your money? That's really the only debate for a stock like Amazon over the next 5 years, right? So, it's a beautiful, beautiful stock. By the way, if you're looking to apply for access to 1000xstocks.com, they'll be in the description area down there. You can apply to join my private group and get access to 1000xstocks.com.
Similar for some of the other Mag 7 names that have reported in the past, call it week and a half, is investors have been really nitpicking and really going through line by line and honing in on very specific metrics, and that has been triggering the selling. Even when there's been top and bottom line growth in things like in the case of Amazon, AWS, which is always typically the thing that drives the stock in one direction or the other. We were just having the conversation with Bob Elliott about stocks having an expectations issue right now. And I wonder how you see it, especially on a day where you have Elliott putting out a client letter saying NVIDIA's in quote-unquote bubble land and being skeptical of AI and calling it overhyped, with many applications not ready for prime time.
Yeah, I can't address the Elliott letter, but I think at the end of the day, what I would frame up for investors is, yes, there is a nervousness. There's certainly less patience for narratives to play out. I think there's elements of, when can I get a return on some of the spend, that's starting to work their way into my investor conversations. And we understand that narrative. Almost every technology and computing shift that I've been through ends up with moments of product innovation, followed by build cycles, followed by a little bit of disillusionment, and those play out over multi-year themes. Yeah. So patience is running thin. There is not a lot of willingness to underwrite less linear narratives.
I don't think patience is running thin yet. It could get to that place, but I don't think yet.
Get a little bit of noise in something like an operating margin in Amazon. It does lead to a sell-off on a one-quarter view, but we would tell investors to zoom out a little bit and see the bigger picture that's of compounded revenue growth and compounded earnings growth that could play out here, irrespective of the AI theme at Amazon over the next 3 to 5 years.
Eric, I was about to say that I was surprised in the investor reaction to Amazon relative to Microsoft, because I felt like Microsoft was way down on the numbers, but then after Amy Hood...
By the way, something else very important in regards to the valuation projections I ran here, very important, is look at the PE estimates I did there, 25 to 35. Keep in mind, Amazon's never traded at those sorts of PEs, really. You look at Amazon's entire history as a public company, the PE ratio is usually anywhere between about 50 and about hundreds, if not 1,000 PE, okay? So when I run a 25 to 35, you just got to understand, that's way lower than Amazon ever trades at PE-wise. Look at the Amazon's PE today, right? It's nowhere close to that. Look at it last year, the year before, the year before, the year before. It's never anywhere remotely close to here. So that's I think that's very important. Everybody understands that.
Into context and what was coming, it went back up again. But I just checked, and they're both down to about early February levels. They've lost 6 months worth of gains almost exactly. Any significance to that?
Well, I think that speaks to the broader point, and it's a good point, John, is that you're basically retracing back to levels where people feel a little bit more comfortable with what they're underwriting in terms of compounded growth and where there might be more visibility. But to contrast it with another name even just this week, look how positively Meta responded to no caveats, no hiccups with respect to the advertising business. And you contrast that with a quarter ago. Meta sold off a quarter ago when there was a little more noise in the advertising business and there was a little less patience with the AI investment. Fast forward 90 days, it reacts very positively this week to very stable advertising revenue, no misses against expectations, and just as elevated an investment narrative from Mark. And I think it's all about elements of expectations, how our core business is operating, and then layering in the investment theme on top of it. That's what's driving a lot of these reactions.
100%. But like I said earlier in the video, Wall Street will make up whatever whatever agenda they want to make up to send stocks down or send stocks up. They could put it on this, they could put it on that. If they want to send it the other way, they'll flip that right around and take the other side of it. Here's why this is good news. Like it's incredible, and it's masterful work on how they do it. To be quite frank, and just as an investor, like an average Joe investor, right? Which average Joe investor is anybody that's investing less than $100 million. Listen, don't play their games. Play your own game. Invest. Buy great companies for the long term. Hold them. If you get big dips on them, add more shares, okay? And have fun. Have fun out there in the market, okay? All right, guys, appreciate you joining me as always. Thanks so much for being here. Once again, pin comment down there. If you want to join me for that Palantir earnings live stream, you can join my Twitch channel there. That will be pinned comment. If you're looking to apply to our private group, get access to 1000x stocks, all that stuff, that's going to be in the description area. Much love and have a great day.